Sunday evening, before Monday's opening bell, Mexico just went dark, military mobilized, airspace shut down, and the world's largest silver producer just became a question mark. But here's what they're not telling you. PAXG is showing a $50 premium. Physical silver is vanishing from Shanghai. And the paper price? Still sitting at $34, as if nothing's happening. 1 in every 4 ounces of global silver comes from Mexican soil, and right now, that supply chain just hit a wall. The gap higher everyone's been waiting for. It might not wait for you to be ready. Welcome back to Currency Archive. You know, I've been doing this for a long time, and I've learned something about people who truly understand markets. They don't just watch, they act. So let me ask you something, my friend. If you've been watching these videos, getting value, understanding what's really happening behind the curtain, why haven't you hit that subscribe button yet? I'm not asking for much, just a simple click, so you don't miss what's coming next. And tell me, where are you watching from today? Drop your city, your country, in the comments. I read every single one, because this community, it's global. And what's happening right now with silver, it affects all of us. Now, let's connect the dots they don't want you to see. Sunday evening, the markets are closed, but the world doesn't stop moving. While most traders were wrapping up their weekend, something significant was unfolding in Mexico. Military forces mobilized across key regions. Airspace restrictions went into effect. Flights were canceled. Roads were blocked. And at the center of it all, a major operation reportedly targeting one of the country's most influential cartel leaders. The political dimensions of this situation are still developing. The full picture remains unclear. But for anyone watching the commodity markets, there's a question that matters more than the headlines themselves. What does this mean for silver? Not next month, not next quarter. What does it mean right now, before Monday's opening bell? Mexico is not just another silver producer, it is the world's largest. Roughly 1 in every 4 ounces of silver mined globally comes from Mexican soil. That's not a marketing statistic. That's a structural reality. When the largest producer of any commodity experiences significant disruption, the market doesn't wait for official statements or comprehensive reports. It responds to uncertainty, and uncertainty in commodity markets is a price input all by itself. The analyst who understands this connection doesn't need complete information. He needs to recognize patterns. He needs to see how supply chains actually function under stress. Mining operations don't collapse overnight. That's not how the industry works. But here's what does happen when a major producer faces internal crisis. Logistics slow down. Transport routes become uncertain. Security concerns delay shipments. Workers hesitate. Operations pause for assessment. None of this creates an immediate halt to production, but it creates friction. And in a market that was already showing signs of tightness, friction matters. The silver market has been sending signals for weeks. Speculative long positions were sitting near 20-year lows, even as prices made aggressive moves upward. That's unusual. It suggests the professionals weren't convinced the rally had legs. But it also suggests something else. The market wasn't positioned for a supply shock. In Shanghai, physical silver was already trading at a premium to Western paper prices. That premium reflects something simple but important. People with actual money were willing to pay more for physical metal than what the futures contracts suggested it was worth. Why? Because physical delivery matters when supply becomes questionable. Paper contracts are useful until they are not. And when doubts emerge about whether metal will actually flow from producer to consumer, those holding physical assets gain leverage. The observer watching these developments understands a fundamental truth about commodity markets. They don't price in disasters after they happen. They price in the possibility before certainty arrives. Mexico's current situation creates that possibility. The country's silver production isn't concentrated across hundreds of small operations. It's concentrated in specific regions that depend on stable logistics, secure transport corridors, and predictable operational environments. When military operations disrupt civilian infrastructure, even temporarily, those dependencies become vulnerabilities. The silver price, sitting at $34, reflects a market assumption. It assumes Mexican supply continues flowing normally. It assumes logistics remain intact. It assumes operations proceed without significant interruption. But assumptions are not facts, and markets that price in assumptions without questioning them create opportunities for those who think differently. The experienced commodity trader knows this pattern. He's seen it in oil markets when Middle Eastern tensions spike. He's seen it in copper when South American mines face labor disputes. He's seen it in lithium when political changes threaten production timelines. The sequence is always the same. First, something happens in a major producing region. Second, most market participants dismiss it as temporary or localized. Third, physical markets begin reflecting tightness while paper prices lag. Fourth, the gap closes violently when reality catches up to pricing. The question facing anyone watching silver right now is simple. Which stage is the market in? Sunday evening provides time to think. Monday morning demands decisions. And the trader who waits for complete information usually waits too long. This isn't about predicting exactly what happens next in Mexico. It's about understanding what happens to commodity prices when the world's largest producer faces uncertainty. History doesn't repeat, but it rhymes. And right now, the rhythm is becoming familiar. The crypto market never sleeps. While traditional exchanges closed for the weekend, a peculiar signal emerged from an asset most people have never heard of. PAXG, Paxos Gold, a digital token backed 1-to-1 by physical gold stored in London vaults. Each token represents 1 troy ounce of actual metal. Not a promise, not a derivative, actual gold that someone can redeem. And on this particular Sunday evening, PAXG was trading $50 above where gold closed on Friday in Western markets. $50. The casual observer might dismiss this as crypto volatility, just another weekend price swing in the Wild West of digital assets. But the analyst who understands what PAXG actually represents sees something entirely different. He sees physical demand outrunning paper supply. When PAXG trades at a premium, it's not because speculators are gambling on price charts. It's because someone, somewhere, wants exposure to physical gold badly enough to pay above the official spot price. They're not buying paper futures that settle in cash. They're buying claims on metal that exists in a vault. That distinction matters enormously right now. Gold and silver have danced together for centuries, not perfectly synchronized, but connected. When gold signals physical tightness, silver typically follows. The metals trade differently, serve different purposes, appeal to different buyers. But they share one critical characteristic. They're both physical assets in a world drowning in paper promises. The $50 PXG premium tells a story that Friday's closing prices don't capture. It tells the story of what happens when geopolitical uncertainty meets weekend news cycles, when people with significant capital decide they'd rather own something tangible than hold cash or contracts. The trader watching this signal understands its implications for silver. If physical gold is commanding a premium, physical silver will follow. The question is timing, and the answer to timing often appears in places most people aren't looking. Shanghai opened hours before Western markets will on Monday, and in Shanghai, silver has been trading differently than New York suggests it should. Physical premiums have been expanding steadily, not dramatically, not in ways that make headlines, but consistently. Week after week, buyers in Asian markets have been paying more for actual metal than what COMEX futures indicate is the correct price. Why? The answer reveals something fundamental about how commodity markets actually function versus how most people think they function. Paper markets are efficient at discovering prices when supply and demand flow normally. Traders buy contracts. Contracts settle. Most positions never result in actual delivery. The system works smoothly as long as everyone trusts that physical metal exists somewhere in sufficient quantities. But when that trust wavers, even slightly, behavior changes. The institutional buyer who normally rolls futures contracts forward starts asking different questions. Can I actually get delivery if I want it? How long will it take? What will it cost beyond the contract price? Are there delays I should know about? These questions don't emerge from panic. They emerge from prudence, from understanding that paper and physical are not the same thing when supply chains face uncertainty. The Shanghai premium reflects those questions being asked and answered. It reflects buyers deciding that paying a bit more for certainty beats accepting paper prices that assume everything flows normally. And everything is not flowing normally right now. Mexico produces a quarter of global silver supply. That metal doesn't teleport from mines to manufacturers. It moves through supply chains that depend on roads staying open, on airports functioning, on security remaining predictable. When the world's largest producer experiences the kind of disruption currently unfolding, supply chains don't break immediately, but they hesitate, shipments delay, buyers start wondering whether their expected deliveries will arrive on schedule. That wondering creates premium expansion in physical markets. The sophisticated observer notices something else about this moment. The divergence between physical and paper isn't happening in isolation. It's happening across multiple signals simultaneously. PAXG premium in crypto markets, Shanghai premium in Asian physical markets, low speculative positioning in Western futures markets, Mexican supply uncertainty in the world's largest producing nation. Each signal alone might be interesting. Together they form a pattern. Patterns precede price adjustments. They don't guarantee them, but they increase probabilities significantly. The analyst who studied previous commodity supply shocks knows what typically happens next. Physical markets continue tightening. Premiums expand further. And then, at some point, that's impossible to predict precisely. Paper markets reprice violently to reflect physical reality. The gap doesn't close gradually, it closes in minutes, sometimes in seconds, because commodity markets reward those who position early and punish those who wait for certainty. Sunday evening provides time to observe these signals. Monday morning will test whether they matter. The PXG premium suggests someone already made their decision. The question is who else will follow before the gap closes. The markets have seen this movie before. Different actors, different locations. but the same fundamental plot. In March 2011, Japan's earthquake and tsunami didn't just devastate communities, it disrupted global supply chains in ways most people never anticipated. Silver was trading around $35 at the time. Within weeks, it touched $50, a 40% move in less than a month. The catalyst wasn't the earthquake itself, it was what the earthquake revealed about how fragile certain supply assumptions actually were. The analyst studying that period notices something crucial. The price didn't move because silver mines in Japan collapsed. Japan wasn't a major producer. The price moved because industrial buyers suddenly realized their just-in-time inventory strategies had no buffer for unexpected disruption. They scrambled to secure supply. That scrambling showed up as premium expansion in physical markets first. Paper markets caught up later, violently. History offers other lessons too. In 2006, labor strikes hit major copper mines in Chile and Peru. Copper and silver often travel together through the same geological formations. When those mines shut down, silver production fell as a byproduct. The market barely noticed at first. Futures traders assumed the strikes would resolve quickly. They didn't. Copper prices doubled over the next year. Silver climbed 70%. Not because the strikes continued the entire time, but because once physical tightness appeared, buyers who previously relied on paper contracts started demanding actual metal. The pattern repeats across different commodities in different decades. A major producing region faces unexpected disruption. Initial market reaction is muted. Physical buyers quietly begin securing supply. Premiums emerge in spot markets. And then, when enough participants recognize what's happening, paper prices gap to reflect reality that physical markets already priced in. The trader examining silver's current technical structure sees echoes of these historical moments. Silver sits at $34, not an arbitrary number. It represents a psychological level that's been tested multiple times over the past 18 months. Each test resulted in rejection downward, until recently. The metal broke above $34 3 weeks ago, held it, retested it, held again. That's not speculation, that's structure. But here's what makes the current setup unusual. Despite price breaking to new highs, the speculative positioning barely moved. The Commitment of Traders report shows large speculators holding near record low long positions relative to price levels. What does that mean in practical terms? It means the professionals managing serious money haven't piled into silver yet. They're watching, waiting, skeptical that the move has legs, which creates an interesting dynamic. If they're right and nothing fundamental changes, price likely drifts back down toward $30. Business as usual. The Mexico situation resolves. Supply continues flowing, premium contracts, everyone moves on. But if they're wrong and physical tightness accelerates, those same professionals will need to reverse their positioning rapidly. They'll need to buy significant quantities in a market that's already showing reduced liquidity. That's how gaps form, not from gradual accumulation, from sudden recognition that current positioning is dangerously wrong. The analyst, tracking industrial silver demand, sees another piece of the puzzle. Solar panel production continues expanding globally. Electric vehicle manufacturing grows quarter after quarter. Electronics demand remains robust. Silver has unique properties. It conducts electricity better than any other metal. It reflects light more efficiently than alternatives. It kills bacteria naturally without chemicals. These aren't speculative qualities. They're physical realities that make silver irreplaceable in certain applications. Industrial buyers don't trade silver for profit. They need it for production. When supply uncertainty appears, they don't wait to see what happens. They secure inventory ahead of potential shortages, all of which are already happening. The technical analyst, looking at price charts, sees resistance levels around $38. That's where previous rallies stalled, where sellers historically emerged to push prices back down. But resistance levels assume normal market conditions. They assume supply flows predictably. They assume buyers and sellers interact in established patterns. Supply disruptions break those patterns. The observer, studying weekend PAXG premiums and Shanghai pricing, sees something else. He sees what happens when markets operate without the stabilizing presence of Western institutional futures trading. Premiums expand, volatility increases. Prices discover levels that Friday's close didn't anticipate. Monday morning will reveal whether those weekend price discoveries matter, whether the gap between where silver closed Friday and where physical buyers are willing to transact Sunday has grown wide enough to force immediate repricing. The veteran commodity trader knows this moment well, not the specific circumstances, but the feeling. The tension between what paper markets say something should cost and what physical buyers will actually pay for it. That tension doesn't resolve gradually. It snaps. And when it snaps, the trader's positioned ahead of the move profit substantially. Those caught on the wrong side scramble to minimize damage. The Mexico situation provides the catalyst. The technical structure provides the setup. The historical precedents provide the roadmap. What happens next depends on whether paper markets acknowledge physical reality before Monday's open or after. The business owner running a solar panel manufacturing facility faces a decision Monday morning that didn't exist Friday afternoon. His quarterly silver procurement happens in 2 weeks. Contracts already negotiated. Prices locked based on Friday's close. Standard practice. Nothing unusual, except now there's uncertainty about whether his supplier can actually deliver on schedule. Mexico's disruption doesn't just affect traders watching price charts. It ripples through every industry that depends on silver as a critical input, and that list is longer than most people realize. Electronics manufacturers need silver for circuit boards and contacts. Medical device companies use it for antibacterial coatings. Photography still requires silver halides for certain specialized applications. Automotive producers incorporate it into electric vehicle components. These aren't optional uses. These are engineered dependencies built into products over decades, because silver's unique properties make it irreplaceable for specific functions. When supply from the world's largest producer becomes questionable, procurement managers don't wait for official announcements. They start making calls, checking inventory, exploring alternative suppliers, considering whether to accelerate purchases before prices adjust. That collective behavior creates demand surges that futures markets struggle to accommodate quickly. The financial analyst watching from outside these industries sees only price movement. The insider managing actual supply chains sees something different. He sees the early stages of a scramble that hasn't yet become obvious to casual observers. This is where information asymmetry creates opportunity and risk simultaneously. The investor who understands commodity market mechanics recognizes what's developing. Physical tightness precedes paper repricing. Always. The sequence never reverses. And the gap between recognition and reaction determines who profits and who doesn't. But understanding the pattern doesn't automatically translate into correct positioning. The disciplined trader asks different questions than the speculator chasing momentum. What's the actual probability Mexico's situation extends beyond a short-term disruption? What happens if operations normalize within days and supply concerns evaporate? How much premium is already priced into Sunday evening's PAXG levels? Where does risk-reward actually sit at current price levels? These questions don't have comfortable answers. They have probability distributions, scenarios with different likelihoods and different outcomes. The professional managing serious capital doesn't bet everything on the gap higher scenario. He structures positions that profit if it happens, but don't catastrophically fail if it doesn't. That's not caution. That's survival in markets that punish overconfidence ruthlessly. Meanwhile, broader economic context matters enormously. Central banks globally are navigating inflation concerns while managing growth risks. Currency volatility has increased across emerging markets. Geopolitical tensions continue simmering in multiple regions simultaneously. Silver sits at the intersection of these macro forces. It's an industrial metal sensitive to economic growth. It's a monetary metal that responds to currency debasement fears. It's a strategic material that governments notice during supply disruptions. That triple identity makes silver's response to current events harder to predict than single-purpose commodities. The analyst who studied previous precious metal rallies knows they rarely follow straight lines. They feature violent shakeouts that eliminate weak hands before continuing higher. They punish late entries and reward patient accumulation. But they also feature moments of discontinuous price discovery, gaps that open and never fill, levels that get tested once and hold permanently. Distinguishing between normal volatility and structural repricing requires understanding what drives physical commodity markets versus financial markets. Financial markets trade on sentiment, momentum, positioning. Physical commodity markets trade on actual supply and actual demand. Eventually, financial markets must reconcile with physical reality. But timing that reconciliation is where most participants fail. The business community watching silver's development needs frameworks, not predictions. Framework 1, monitor physical market indicators. Shanghai premiums, PAXG spreads, delivery delays, warehouse inventory levels. These signal whether tightness is real or imagined. Framework 2, track Mexico situation developments, not headline drama, but operational specifics. Are mines operating? Are transport routes open? Are shipments moving? Framework 3, watch institutional positioning changes. Does the commitment of traders report show large speculators reversing their skeptical stance? That signals professional money, acknowledging something changed. Framework 4, observe cross-market correlations. Is gold confirming silver's move? Are other industrial metals showing similar patterns? Isolated moves often reverse. Coordinated moves often persist. These frameworks don't guarantee correct decisions. They reduce the probability of catastrophically wrong ones. The entrepreneur building wealth over decades understands something crucial about commodity markets. They offer asymmetric opportunities periodically, moments where potential upside vastly exceeds downside risk if positioned correctly. But identifying those moments requires distinguishing between noise and signal, between hype and structural change, between temporary disruption and fundamental repricing. Mexico's current situation creates uncertainty. PXG premiums signal physical demand. Shanghai spreads confirm tightness. Technical structure shows potential for gap expansion. Each data point alone is interesting, Together, they form a pattern that deserves attention. Not panic, not reckless speculation, attention. The kind of attention that allows someone to act decisively if conditions confirm the thesis, or step aside if they don't. Monday's open will provide crucial information. How does silver price in the first minutes of trading? Does volume confirm movement or suggest thin liquidity creating exaggerated swings? Do physical premiums expand or contract? The observer who monitors these signals without emotional attachment gains advantage over participants reacting to headlines, because markets don't reward those who follow crowds. They reward those who understand structure, recognize patterns, and position before consensus forms. The gap higher scenario isn't certainty. It's probability weighted by current evidence. And probabilities, properly understood and acted upon, create wealth over time. That's not speculation. That's strategic analysis applied to real-world events.